Forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandeep Thomas Mathew, Head Investor Relations, for his opening remarks. Thank you, and over to you, sir.
Everyone, I welcome you all to the Q2FY23 earnings call. Along with me, I have Mr. Amit Jain, our Global CEO, Mr. Bahadur Dastoor, our CFO, and SGA, our IR advisors. We will start the call with an update on the solar power industry and operational highlights for the quarter by Mr. Amit, followed by the financial highlights by Mr. Bahadur, post which we will open the floor for Q&A. Thank you, and over to you, Amit.
Thanks, Sandeep, and a warm welcome to all the participants on this call. I would like to give a quick update on the solar power industry, other allied renewable businesses, and status on our business operations. Now, coming to solar EPC industry and opportunities, the global solar market is growing exponentially. It took around a decade for worldwide solar capacity to reach 1 terawatt from 100 gigawatt in 2012. In just 3 years, Solar Power Europe predicts global power to more than double 2.3 terawatt in 2025. Solar remains the fastest growing renewable energy, representing over half of the 302 gigawatt of renewable capacity installed internationally in 2021. With 168 gigawatt of additions, solar installed over 70 gigawatt, more than the next greatest installer wind, and more than all non-solar renewable combined. The role of solar in the global energy transition is getting more and more prominent, considering that in 2021, solar alone installed more capacity than all other renewable technologies combined. In 2022, global solar is expected to continue the decade-long record-breaking streak, installing more than 200 gigawatt of solar for the first time. Solar's success story over other technology has many reasons, but a key factor is its steep cost reduction curve over the last decade. It has made solar the global cost leader. While the cost of solar has been lower than fossil fuel generation and nuclear for several years, it is also now lower than wind in many regions around the world. Bloomberg NSE estimates for the global LCOE for utility scale PV stood at $45 per megawatt hour in the first half of 2022. Despite losing some ground, this still marks an 86% reduction since 2010 in nominal terms. Now, wind solar projects are now around 40% lower than BNFE's global benchmark for new coal and gas-fired power, which are at $74 and $81 per megawatt hour respectively. The spread with conventional generation technology is widening, considering that the cost of coal, gas, and nuclear went up. Despite the record increase in modules, commodities, and trade over the last 24 months, the LCOE for solar plant is still cheaper than the traditional source of energy as well as the renewable source of energy. There are strong levers which will drive robust growth globally over the coming years. Stronger policy support from the government in terms of tax incentives, favorable policies for renewable sector coupled with ambitious climate target announced for COP26 are going to drive demand for solar energy to new records worldwide. Solar industry is well poised to grow in long term as IPPs have huge plans for global capacity additions. The global tariffs have already corrected upward with the revision in prices, and a lot of projects are expected to get finalized in FY23, especially H2FY23. Indian solar power capacity has surged over 17-fold to 59 gigawatts since Honorable Prime Minister Narendra Modi came to power in 2014. The Indian government has accelerated its plans for clean energy transition, with Prime Minister Narendra Modi pledging to build 500 gigawatts of renewable energy, with 60% of it coming from solar. This is to ensure that half our energy requirements will come from renewable resources by 2030. Thus, we expect outstanding growth in Indian solar power industry in the years ahead. The public sector has been called upon to join the cause too, with state-run giants such as NTPC, NHPC, SJVN, NLC India Limited, Coal India Limited, etc., crafting solar plans and indicating a strong pipeline. The government is also persuading and incentivizing the private sector to shape India's clean energy future and make it a sunrise sector, just like IT services after 1991 economic reforms. Major Indian conglomerates have announced investments and commitments toward renewable energy targets, with about 151 gigawatts of renewable energy expected to be added by private clean energy companies alone. India has also announced a roadmap to become a hub for the production and export of green hydrogen made from water and renewable electricity. India has set a 5 million ton green hydrogen production target by 2030 to help bolster its geopolitical heft and be a game changer for the country's energy security. With the government promoting the new age emission-free fuel, Reliance Industry has also shown significant interest in the space. With this development, we expect huge increase in the scale of average project size in the Indian solar industry. Utility-scale solar market performance was mixed in the second quarter. A total of 2.7 gigawatts were installed in Q2, just 500 megawatts more than Q1, constituting a 25% decrease from Q2 2021 and a 17% increase from Q1 2022. Though the first half of the year deployments are at their lowest level since 2019, supply chain constraints and trade policy issues continue to suppress utility-scale solar installations. The U.S. utility-scale segment experienced a volatile period over the last several months. First, the executive order delaying new tariffs was a relief which allowed developers to resume activities as Southeast Asian manufacturers could restart module shipment to U.S. But then UFLPA, the UGR Forced Labor Prevention Act implementation led to detention of several module shipments, further constraining supply and hindering project construction. Post that, the historic passage of the Inflation Reduction Act, IRA, in August will prove to be a massive growth catalyst for the solar industry. However, due to the near-term supply chain constraints, according to Wood Mackenzie report, most 77% of the effect of IRA will be materialized in utility-scale segment after 2024. The lack of equipment availability has led to a continued project delays, thereby decreasing the 2022 forecast by 600 megawatts to 8.1 gigawatts, the lowest annual total since 2018. The industry will continue to navigate the UFLPA requirements during the rest of the year, and supply is expected to return to a steady state at some point in 2023. More than 30 gigawatts of renewable power projects are expected to be permitted on BNN lands between fiscal year 2022 and 2025. The vast majority of the capacity will be solar powered. In Australia, the torrential rains adversely impacted the solar EPC activity. It is also facing resource shortage of white and blue collar manpower. However, the recent election has been a game changer in terms of the policy support for renewable energy. The new Labour government has plans to unlock renewable investments, upgrade the grid, and bring federal policy more in line with states and territories, many of which have more ambitious climate goals. Labour's main energy policy, rewiring the nation, includes plan to funnel $20 billion Australian dollars into new transmission links to accelerate the uptake of more clean energy. The plan is part of Labour's pledge to cut Australia's 2005 level greenhouse emission 43% by 2030, projecting renewable reach and 82% share, which was earlier 69% in the national electricity market by then. The government also raised the migration cap in September 2022 to address the issue of skill and labor shortages. Global Data says in a new report that solar installation in Australia could grow by a factor of 4 by 2030. It estimates that the country will reach a solar capacity of 80.22 gigawatts in 2030 from 17.99 gigawatts in 2020. In June 2022, the EU energy ministers agreed to increase the share of European energy consumption coming from renewables such as solar or wind power to 40% by 2030. The impact of the Russian war on Ukraine and the accompanying energy security challenges alongside EU climate goals are deriving the continent's renewable transition, with 25 of 27 EU member states set to install more solar in 2022 than 2021. As the continent reels from the Russian war on Ukraine, the EU has refocused its attention on the role of renewables in energy security, with EU expected to install 39 gigawatts of solar power this year. The real acceleration will happen in the medium term, with upward of 100 gigawatts of annual installations by 2025, paving the way to 1 terawatt of solar by 2023. As per the International Energy Agency, by 2026, global renewable electricity capacity is estimated to rise more than 60% from 2020 levels to over 4,800 gigawatts, equivalent to the current total global power capacity of fossil fuel and nuclear combined. Renewables are set to account for almost 90% of the increase in global power capacity through 2026. With solar PV alone providing more than half, our focus is to grab large share of EPC capacity additions in FY23, like 23 gigawatts in USA, 16 gigawatts in Europe, 3 gigawatts in Australia, and 16 gigawatts in India. It is estimated that solar PV utility scale market, excluding China, is expected to grow at 15% CAGR over the next few years, with growth led by developed markets like US, Europe, Australia, as well as the India market. During the recent 45th AGM, Reliance Industries announced plans for starting production of solar cell, battery packs, and green hydrogen from the Dhirubhai Green Energy Giga Complex. Reliance plans to commence manufacturing of solar photovoltaic cells and modules by 2024 with an annual capacity of 10 gigawatts. That will be scaled up to 20 gigawatts in a phased manner by 2026. Reliance is already one of the largest producers of grey hydrogen globally and aims to progressively start the transition from grey hydrogen to green hydrogen by 2025. Importantly, Reliance plans to have 25 gigawatts of solar energy generation by 2025 for its own captive needs. We expect to get a meaningful pie of work from Reliance's new energy goals. I would like to state that with our global reach, strong relationships with customers and lenders, as well as the induction of Reliance Group as an additional promoter of the company, we are well positioned to capitalize on these growth opportunities. Reliance Group investment in company has led to strengthening of company's balance sheet and increased confidence to customers, suppliers, bankers, and other stakeholders. Now I will give you an overview of our solar O&M business. Our solar O&M portfolio as of date is 7.2 gigawatts, with third-party O&M constituting approximately one-third of the portfolio. While our portfolio has increased vis-à-vis March 2022, we anticipate about 1.8 gigawatt of the portfolio, which is currently under construction commissioning phase, to start contributing to the top line by Q4FY23. O&M constituted 5.4% of revenue in H1 FY23 and stood at rupees 82 crores. We are focusing on increasing international O&M portfolio through organic and inorganic route. With more and more processes and procedures digitized in O&M, we are unlocking the value of predictive maintenance and making increased use of it. which results in improvement in efficiency and general reduction of our levelized cost of electricity. We aim to further increase our market share in O&M segment by identifying profitable opportunities through global customer mapping. We are also leveraging our strong partnership with global IPPs. I will present you with the best opportunity. With the increase in clean energy capacity in the grid and its subsequent decarbonization, ramping up energy storage has become critical and extreme necessity. Moving forward, on a global scale, a 20 times growth is estimated in energy storage by 2030. Until 2040, a 60 times growth has been projected, compared to 34 gigawatt of energy storage currently available. According to Vision 2030 report of India Energy Storage Alliance, at least 160 gigawatt hour of energy storage will be needed by India by 2030 to integrate a targeted 500 gigawatt of non-fossil fuel energy based on its analysis of India's energy sector and outlining the requirement of energy storage in the country. We recently entered into a MOU for an EPC project which includes battery energy storage system for total installed capacity of 455 megawatt hour in Nigeria. We have added team of battery experts, sales and execution team to capture this market opportunity, and we have built pipeline of 1.4 gigawatt hour across US, Australia, US and LATAM. We see pretty robust growth in this market, and with RTC tenders due from Government of India in coming years, we see a robust growth in the Indian market as well with respect to battery energy and storage space. With this, I will ask Mr. Bahadur, our CFO, to take you through the order book and consolidated financial highlights. Thank you very much.
Thank you, Amit, and good morning, friends. Speaking about the order book, in August 22, the company emerged as the L1 bidder for the BOS package comprising 4 blocks of the solar PV plant of NTPC Renewable Energy Limited at Khavda RE Power Park, Run of Kutch, Gujarat, with an aggregate capacity of 1,570 megawatt DC. The total bid value, including O&M for 3 years, aggregated to 2,212 crore, inclusive of taxes. The contract agreement for the project has been signed between the company and NTPC Renewable Energy in October 2022. In September 22, the US step-down subsidiary of the company signed a memorandum of understanding with the government of the Federal Republic of Nigeria, along with its consortium partner, Sun Africa, for the development, design, construction and commissioning of solar PV power plants aggregating to 961 megawatt at 5 different locations in Nigeria, along with battery energy storage system with total installed capacity of 455 megawatt hours. Financing for these projects is under negotiation between US Exim, ING and the government of Nigeria. The transaction is expected to consummate by Q4 FY23. Here, I would like to add that Sterling and Wilson Group has a strong presence in Africa and has an excellent reputation in Nigeria for successfully executing projects in the power sector. Our unexecuted order book as on September 30th stands at 2,654 crore with nearly 78% domestic EPC, which is executable over the next 12 months. Our order bid pipeline remains robust and we are still awaiting results of approximately 19 gigawatt of bids that are likely to be announced in H2 FY23. We are on track to achieve and may exceed our earlier given FY22 guidance of $1 billion in new orders other than those of group companies. The prices of modules, commodities and logistic costs, which had hardened due to geopolitical tension in the first half of the year, have begun to moderate. A lower cost curve is likely to help tendering activity gather momentum, which should help result in more order finalizations in the second half of FY23. I will now take you through the consolidated financials for the half year ended September 30th, 2022. Revenue for H1 has been at 1,520 crores as compared to 2,630 crores in H1 FY22. Revenue and margin trajectory in the EPC business is anticipated to normalize from Q1 of FY24. O&M constituted 5.4% of total revenue in H1 FY23. New site additions to O&M portfolio is likely to start contributing to top line from Q4 FY23. Company level, the gross margin remains suppressed primarily on account of international EPC projects. In the US, labor costs increased due to shortage of labor supply, and in Australia, labor cost, site overheads increased due to loss of productivity on account of extreme weather conditions. Further, there was a translation loss due to adverse movement in exchange rate between the USD and the INR and the AUD INR compared to March 22. O&M margins were impacted by projects where O&M costs were incurred. However, revenue recognition has not commenced due to clients delaying final handover. O&M margins were also impacted by non-recurring costs of about 10 crore during the quarter. While we anticipate revenue to be recognized on a retrospective basis, we have provided for the cost incurred upfront. Coming to the balance sheet, as on September 30th, 2022, the net worth stood at 338 crores on a consolidated basis, and cash and cash equivalents stood at approximately 428 crores. Our net debt stood at 885 crores. We expect net debt to decrease with new order inflows and completion of US and Australia projects. Advance and performance bank guarantees encashed by 4 customers amounting to 588 crore. With one customer, we have signed the final settlement agreement, and the encashed amounts for 2 projects totaling to 350 crore have been refunded by the customer. With respect to the balance 2 customers whose projects are completed, the company is in discussions with them. As on September 30th, we had negative working capital of 272 crore as compared to negative working capital of 302 crores as on March 22. Receivables due for more than 1 year as at September 30th stood at 362 crores compared to 261 crore as on June 30th. They comprised related party receivable of 30 crore, which is net of 175 crore that the company needs to pay back to the related party against advance received for the waste to energy project. With this, we can now open the floor to questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Abhineet Anand from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Just wanted to understand on the Nigeria MOU, can you give some details in terms of the size, in terms of value and our share, given that we have probably bid with Sun Africa as a partner?
Yeah. Good morning, Vineet. So to start with the Nigeria opportunity, Sun Africa is a very reputed developer which is developing projects across multiple geographies, including Africa. They are developing projects in Europe. They are developing projects in Africa, and in Africa particularly, they are very active in Angola and Nigeria. So they have developed a portfolio of 5 projects in Nigeria, in which we are cooperating with them. And has entered into an alliance to develop and carry out EPC activity on those projects. We have signed the MOU with the Ministry of Government of Nigeria for construction of these projects, and we are in negotiation to conclude the EPC agreement with them.
Any color on the value, order value, sir?
We have given the values to the tune of, like, we are expecting that, still negotiating, but we expect it to be close to $1.5 billion.
Okay. Then that itself takes, as Bahadur did mention, that for the current year, we are expected to exceed our earlier guidance of $1 billion of inflows, right?
Yeah.
That itself you are saying.
Right.
And this $1.5 billion that you are saying is our share?
Yeah, 1.5 billion is share for both the partners.
And what's our share in that, sir?
Our share, Abhineet, would be in excess of about 95% of the total value, rest being on account of development. But as Mr. Amit has mentioned, this is still under various stages of negotiation. The range, though, is what is the number that he has mentioned.
Okay, so then it takes to the point that probably our guidance looks to be significantly below what we probably might achieve. Obviously, it's in negotiation stage. But if I have to just, add here that if we look into a 2 years perspective rather than just 1 year, that what guidance we have seen, what could be a very realistic number in terms of inflows that one can have? 2 year or 3 year, whatever, is suitable to you guys.
Yeah. So, as we are stating in our various conference calls, that domestic market is significantly moving up. We have recently bagged 1.5 gigawatt order from NTPC. The value of that order net of taxes is approximately 1,800 crore plus. So, and we have stated that Reliance would be carrying out works of 20 gigawatts, and we expect to get a meaningful pie of that work. So that values can be extrapolated from that aspect, what kind of inflows can be expected. We are negotiating deal in Nigeria and international and both domestic markets, other than these particular projections, continue to be robust. So we expect that the value, the guidance of $1 billion, which was provided earlier, we significantly expect to move up, and the revenues inflow will grow significantly in next 2 years.
And we need to add further, that would be the kind of target that we are aspiring to work on towards the next 2 to 3 years. Of course, trying to exceed that as well.
Okay, sure. And Bahadur, just on the balance sheet side, if you see your first half, basically, almost our net worth has come down from 600 to 300 odd, largely because of the loss that we have incurred. Though we have a bit of cash, do you think there will be a need of some either raising your debt or equity infusion that will be needed this year, given that inflows will probably happen in H2, so revenues will probably start kicking in 1Q24?
There would be some amount of funding that would be required to complete the existing projects. The company is also internally having discussions in terms of the net worth. We will be able to provide guidance on what exactly needs to be done by the time we have the call for the next quarter. But there will be a certain increase which will happen right now in the funding requirement, which the company has more or less tied up with to close the existing projects.
Okay, last one from me. Amit did talk about the battery storage part, right? India is still in the nascent stage, and there is a lot of growth opportunities that people feel are there. If you can highlight from your international experience as to the pricing, what's in the other parts of the world, and what pricing that India is presently having, and what can so per unit, how will the battery power look like if we use battery storage today in India, and globally what's happening right in the pricing front?
See, so as far as the battery pricing is concerned, so the major battery suppliers still continue to be from international markets. So as far as the major part of the cost comes from the battery supply part, but the EPC portion or the construction portion constitutes only 15 to 20% of that part, and the cost of that continues to be $250 per kilowatt hour for the battery supply portion, and total EPC part is around $300 per kilowatt hour. The per unit rate depends upon the usage, what kind of usage and what kind of RTC requirements clients have or what kind of grid requirements it would be used for. So it is extremely variable and various multiple business models are evolving in the West and same will be emulated in India. So the per unit cost of stored electricity or from the best model will be varied as per the use and the customer requirements.
Okay, sir. Thanks for the answer, and I will get back in the queue. Thank you.
Thank you.
Thank you.
Next question is from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
So, sir, this Nigeria order as well as the new NTPC order, what are the kind of estimations we have made for the gross margin in these two projects? And if at all, you could also mention what the ultimate EBITDA will be from these projects. My second question is that we are now going for a multi-country execution, and just also in the case of Nigeria, there are almost like three counterparties involved: the government of Nigeria, then Sun Power, and also US Exim. So we have these various countries that we operate in, and there are various vagaries. Like you just said that US the employee cost has risen. Australia there are some problems of rain. So mathematically, how will we see to it that Sterling Wilson is not affected due to this? Because one project failing and our EBITDA margins don't really allow for any kind of deviation. And there are so many factors which are just beyond our control. So how will we do it? Because this is like multi-country and then there are multi-risks.
So I'll start out, Mr. Hawa, and then maybe Amit can pitch in a little later. I'll try and answer all your questions one by one. See, I wouldn't want to go down to project level margins and say what kind of margins we are obtaining in Nigeria or what kind of margins are there in NTPC. Suffice to say, it would be close to what we have been historically doing in a range, and that's what we are aspiring to do. That is to answer your first question. Second, as far as the unseasonalities of rain that have happened, as well as in Australia, as well as labor costs which have gone up, the company has now strengthened its risk matrices. We earlier used to also take this into account. In the case of Nigeria, as well as in the case of NTPC, most of it is subcontracting. It is not something that is going to be self-performed, and therefore all those risks we would as an organization also pass on to the subcontractors. As far as pricing is concerned, yes, while there would be pricing which is there even for modules in the case of the Nigeria job, the NTPC job is without modules. There are firm commitments which are being taken from vendors, having learned from all our experiences in the past, to ensure that there is no slippage of margins. When we talk of margins, Mr. Hawa, we always talk of gross margin because for us, the overheads are basically a total cost across the various entities of this organization. So we don't look at EBITDA level margins for projects. That would be at an organizational level. That number is in the range of 400 to 450 crores. And as your turnover increases, which you can see from the order book, your operating leverage is obviously going to kick in, which gives you a greater EBITDA margin. We will, of course, need to be more careful in Australia and US. We will be more selective and risk-averse in these geographies. Though historically in India and Africa, we have always made good margins, even in the toughest of times. As far as the Nigeria job is concerned, it is funded through US Exim, or it is proposed to be funded through US Exim. And most of the suppliers would be US suppliers. Contracts there are extremely strong. And US Exim has already done funding of a similar project in Angola of a very large size. If I have missed anything, Mr. Hawa, please just remind me, and Amit can pitch in if I have missed anything.
Bahadur, you have summarized it wonderfully. You have captured practically all the things. So, Mr. Hawa, as you're saying, in multi-geography now, as Bahadur alluded to, the risk matrices are being reviewed and we are changing our risk profile. So in negotiating the contracts and building contingencies around the inclement weather or labor shortages. So we are bidding selectively and we are taking care of the risk profile we are taking so that the margins remain intact, whichever geography we are working in. And all the geographies, wherever we are working, we have put in very, very strong teams. so that the execution risk is minimum and we pass on the risk through subcontracting model to our subcontractors.
So in any of these two contracts, will we have to give some kind of bank guarantees also to the counterparties?
Yes, of course, Mr. Abbas. Bank guarantees are always part of every contract.
So, at least can you tell me what are the gross margins we have targeted in these two projects? Because that gains very much importance, because we have to, as investors, also, get into our calculations various vagaries that will come through in future, So, whatever steps we may take, but, these vagaries are such that, many times even the management cannot budget for them. And we have seen in the past that it is not only the solar modules. Many a times, one or two projects have, affected our entire year's performance.
So I would just like to say this much, Mr. Awa, that the mix for gross margins for all new jobs would be low double digits, combining all contracts together. I would not want to go into, discussing project level margins, at least by project.
And what is our realistic target for orders now? Because we have already achieved the target for the year. So how many more orders will we take so that, we don't go too far into the future where, prediction of raw materials and all may become much more difficult? Or will we just, take all the orders and then just make the counter bookings with the suppliers?
So I'll start off by saying that most of the orders that we generally take are having a closure period of between 15 months to 2 years. So it is not something that we would take and then sit on the order for the next 2 to 3 years. That's not how the solar business operates. We have presently, so while it is an MOU, you can say that we are looking at exceeding our targets. However, that does not mean that we are shutting shop. We are right now involved in bids, as has been mentioned by Amit as well as me, for a very large portfolio across the world. Plus, there are a lot of bids coming in India. India has always been our strength. Our domestic margins continue to be protected. They were so in March, they are so in June quarter as well as in September quarter as part of our investor presentation. And it is something that we are aggressively pursuing so long as our blended margins that we internally have are taken care of.
And what is our hiring program for engineers for the next 2 to 3 years, for the next 1 year at least?
So we have mentioned that, Mr. Abba, that we are looking at increasing our total team size to take care of all of these new jobs. We are already looking at increasing our domestic headcount to about 1,500 from the present headcount that we had in March of about 467. At the same time, there have been some reductions in places like Australia where jobs are coming to an end. That is to, of course, be very efficient and lean in terms of our operation. But right now also, we are looking at increasing our headcount for design and engineering by about 195 people, construction 615, project management about 120. You will see that the corporate headcount, the back end is just about 40 people, because as a back end, we already have enough strength to take care of the projects that we are looking at.
Okay.
Thank you. The next question is from the line of Siddharth from MK Ventures Capital. Please go ahead.
Yeah, thank you for the opportunity. So my first question is on the gross margins again. You guided for low double-digit margins. Just wanted to understand the difference between the projects where you have taken with solar modules and the projects where you are not taking with solar modules. If you can just give some bifurcations where we know further whenever we win project, what kind of gross margins we'll make on those projects.
We always get margins even on the modules, though module prices being known to everyone, the profit margin on modules is a little lower as compared to if you were to take a BOS margin. When we are giving you this number of low double digit, it is considering a blend. Though if you were to look at it purely from a BOS perspective, it would be maybe a slight higher number as compared to the one with modules.
Sure. And the capital projects, the Reliance projects, whenever we win, those projects will be also at similar margins? A low double digit broadly?
We hope and expect that they will be, because both parties have to come to a conclusion on what the margins will be. But yes, that's our aspiration.
Great, sir. So second question is on the order book now. So as of now, 12th October, we have the order book of
Just to add that both NTPC as well as Reliance will be all BOS. There are no modules in that. Sorry, I missed saying that before.
Yeah, so that will be at relatively higher margins from just percentage terms.
Yeah, we will try to upgrade our margins.
Okay. And the current order book as of now, which is booked as 2,600 crores. So out of this, how much is the legacy orders where there will be still some losses, sir? And what can be the extent of these losses which will flow through our P&L in next 2 quarters?
So let me put it in a little bit of perspective. So out of the order book that we have roughly between 550 to 600 crores of the legacy orders, where there is no loss, but there is no profit either. They are at more or less a break even because we always account for all the losses up to a point in time. To give you a perspective of this 500-600 crores, it is only about 6 to 7% of the total order values of all of these legacy orders. So today we are at the fag end of all of this. We are hopeful of closing.
And at the time of closure, we don't expect any major liabilities to arise at the end of this project.
Participants, please stay connected. Line for the management dropped. Participants, please stay connected while we rejoin the management back to the call. Ladies and gentlemen, thank you for your patience. We have the line for the management reconnected. So please go ahead.
Yeah. So, sir, are you suggesting that we will not have any further P&L losses or cash outflow on the legacy orders from now, or we are mostly provided for all the losses?
Losses we have accounted for whatever we had to, and wherever we had any subjectivity, we have given that in the notes to the financials. As far as cash outflow is concerned, yes, we would require to do a certain incremental borrowing to complete those existing projects. So right now we have done borrowings of about 700 crores, of which we have about 400 crores lying as a cash and bank balance. Over and above that, there will still be a requirement because one is accounting for the loss and second is paying for those payables to complete the projects. We will be doing that. Part of our borrowing plan, most of it which is already tied up with participating banks.
So, sir, how much is the cash outflow which will happen on these legacy projects going forward? I mean, a broad range, if you can share the estimate.
That figure would be in the range of a further 300 to 400 crores over and above the bank balance that we have. And
this is after the indemnity agreement which we had with the
It is after the indemnity claim for crystallized items as on 30th of September 2022.
Okay. So, sir, broadly, the last question from my side. Broadly, we have, say, 885 crores of net debt and a customer advances of, say, 300 crores, negative working capital of 300 crores. So, we are, in a way, around 1200 crores of borrowing. And further 300 crores is 300 to 400 crores is the maximum liability which can arise. So by the end of this year, when we are done with all the legacy projects, we can have 1500 crores of liabilities if we exclude the customer advances. Is that broadly correct, sir?
Yeah, but it also depends on the advances which we will get from the new jobs that we are working on right now, which will go to reduce that. You are looking at it at a gross level. there will always be customer advances from the jobs which will go to bring it down.
Understood, sir. Great, sir. Thank you. Thanks for the clarification.
Thank you.
Thank you. The next question is from the line of Anupam Goswami from B&K Securities. Please go ahead.
Hello, sir. So my first question is on the NTPC order.
Anupam, sorry to interrupt you. Hello.
Hello. Yeah. So my first question is on the NTPC order that we have received. So what I was checking, it was about 1.3 per megawatt order. So is it like full EPC contract? Because that's a bit of low in my understanding. So if you can throw some light on it.
Could you just repeat your question one time, please? I missed something
sure.
in the middle. Yeah.
So the NTPC order of 2,200 crores for 1,600 megawatts. So it's coming about 1.3 per megawatt. So is it the whole EPC contract that we understand, or there is any clause or conditions in that partially, if it is there anything?
2,200 crores for 1.5 gigawatt includes O&M for 3 years and includes the taxes. If you take that out, the value comes, if you exclude all of this out, the value comes closer to about 1.2 per megawatt, 1.2 crores per megawatt, which is the average BOS price. It is not a full EPC contract. If one were to do EPC, it would be upwards of 3 crores a megawatt.
Right.
Okay. So this is a
BOS.
Yes, please.
Okay. I understand, sir. And sir, how much margin are we, commanding on BOS supplies?
I already answered that question a little before, that I don't want to go to project level margins, but on an average, it is low double digit that we work towards.
Okay. And sir, my last question on the kind of module prices we are. So our EPC contracts, domestic, if we say, what kind of margins do we see going forward? Do we see any challenges in that to maintain the margins?
So modules does not have for us an impact as far as domestic is concerned, because almost all our orders in the domestic front are without modules. So the margin profile that I gave you includes what we do in India as well.
Okay. And so where are we sourcing mostly for our equipments and modules?
Modules worldwide would obviously have China as a great factor. As far as the job that we are working on in Nigeria, since it is US EXIM funded, we assume that US EXIM will have a great role to play in determining who are the major vendors for that particular job.
Okay, sir. Okay, sir. I understand. I'll join back in the queue. Thank you.
Thank you.
Thank you. The next question is from the line of Manoj from Geometric Wealth Advisors. Please go ahead.
Congratulations, sir, on winning a lot of orders and bringing back company on the order front. My first question is, let's assume go forward 2-3 years when the company balance sheet is more strong. Hypothetically, if you're getting 30,000 crore of order in a particular year, so is there any capacity constraint in terms of labor or in terms of sourcing? How to think of in terms of capacity of taking order? And similarly, how much we are taking orders around $1.5 billion this year, hypothetically. Okay, the project schedule is 15 to 24 months. How much we can execute in a particular year? Can you take an NTPC example in that? It will be very helpful. Thank you.
Yeah. So as we explained earlier during the call that we are increasing our capacity, we are increasing our bandwidth to address the increased market size. So this year itself, we are adding people in excess of more than 1,000 people. We are strengthening our engineering, procurement, and project execution team to address the increased market size and the increased order book which we anticipate. So anytime we are negotiating any particular order book, so we have some time in hand and we have a clear visibility in which quarters we are going to book and what would the execution plan look like. So we start working in advance and start adding capacity. Like NTPC, we have time of execution time is 18 months and we have sufficient bandwidth to execute that order in that particular time frame. if you see historically, we have achieved a turnover of around in excess of 8,500 in particular year. If you adjust that, we can easily handle a turnover of 10 to 12,000 crores without much increase in our overhead, and we have that bandwidth. So we are very, very well placed to handle any increase in the order book, and we are very well placed for that, and our organization expansion plans based on anticipated order books are well in place.
Okay, thank you. So let me take a summary of that. For having more order, we need more employees for that. Means the major part you are saying.
What I said, like we need the employee for execution, but our back end for the management teams are in place. But wherever we need, like most of the work will be carried out through subcontractors, and where we ever need to execute in-house. So we are very well positioned for that expansion, and we are expanding our engineering team, and we'll be able to cater to that. But it will not lead to any significant increase in overheads.
I understand. So coming back to my question, looks like we are going to have a lot of orders from our Reliance Group also, and we are bidding in more area, and there is a long tailwind also in this sector. So if that kind of orders we want, if we are getting 25,000, 30,000 crore, we can increase our capacity for that. Is it possible for organization Sterling?
Absolutely, it is possible to expand the capacity to that. It is absolutely possible, and we are working towards that. And if we foresee that that kind of order booking is happening, that will be addressed accordingly.
Okay, great. And my second question is, for the time being, we can take a fixed recurring over at cost as 400 crores. Is it my right assumption?
Between 400 to 450 crores over the next 2 to 3 years, considering inflation or some little addition to back end, is the kind of range that we are working towards.
Okay. And my last question is regarding this raw material. How much still we are fragile or dependent on the China thing? Is this situation improving? And what do you see going forward with a lot of capacities being putting in India? Thank you.
Yeah. So can you repeat yourself again? Once again, what's the question?
Okay. My question is, in terms of procuring raw material, how much dependency this still solar industry have on China, and how much it is, do you think going forward in 2-3 years it can be reduced, as a lot of people are putting capacities in India and outside also?
So as far as the module sourcing is concerned, at this point of time there is a major dependence on China, because China controls most of the capacity of solar modules. But as you yourself have said, there's a lot of capacity addition is happening, not only in India, but most of the other parts of the world. So I see a lot of capacities coming online in next couple of years in India and other parts of the world, which would significantly reduce dependency on China, and will be able to source the modules and all other materials from either India or multiple other markets.
Okay. Thank you. I will join back in the queue for questions.
Thank you. Next question is from the line of Shantanu Mantri from Think Investments. Please go ahead.
Yeah, hi. Thanks for the opportunity. So I had two questions. First is, on with a broader perspective. So,
Shantanu, sorry to interrupt you, but your voice is breaking. May I request you to come in a better reception area, please?
Yeah, is it fine now?
Yes, thank you.
Yeah. So my first question is that, last couple of years, our projects in Australia, US, we faced huge losses, and now we're coming to kind of fag end of all those orders. The quantum of these losses, were massive. Like, we've just eroded almost our entire net worth. Having said that, now we stand at a point where, we have these big orders coming in from Nigeria, and we have the whole Indian domestic story. So my coming on to my question is that, what are the few big risks you see, in this Nigerian order, that can, affect us, or rather, what is the comfort you have that, whatever we've seen in the past will not repeat again? If you can just share, how we've changed on our, risk analysis, will be really helpful.
Yeah. So, as you have started the question with US and Australia, I would like to point out that the last 2 years were exceptional.
Right.
For the whole world because of the pandemic, the breakdown of the entire supply chain, and the entry restriction in those two geographies where we could not supplement the teams with expertise and workers. So they were very, very different circumstances, and we are over that. That particular part of the order book is to the back end, and legacy projects are about to be over. As you are aware that we have a strong presence in Africa, and we have executed projects successfully on more than 10 countries in Africa. We have already have a huge presence in Nigeria. Our group companies have carried out projects in Nigeria. Sterling Wilson Solar has already executed on a smaller scale for 4 projects in Nigeria. So as far as the African and Nigerian execution piece is concerned, we are very, very confident, and we are one of the most successful contractors in Africa. Now coming back to the supply part, Nigeria job is funded by Exim Bank of US, and most of the suppliers are going to be from US or the allied countries, and it's the quantity of the contracts in those geographies is very, very high. So it's not the kind of problems which we faced in Australia that the suppliers reneged on their contracts. That is not going to happen on the Nigerian contract. And as far as coupled with our execution experience in Nigeria, most of the construction jobs will be subcontracted, and risk sharing will be done with the subcontractors. So I feel that as far as the Nigerian piece is concerned, we are very well protected, and we have ring-fenced our risks to most of the extent on Nigerian projects.
Got it. Okay, that's really helpful. And my second question is more on our balance sheet, particularly our debt. So I see right now we have around some 880 odd crores of net debt. I believe that this will increase by another 300 crores by end of March. So we'll be somewhere around. This is excluding any advances from the NTPC order. I don't want to get into those advances, but on a pure legacy order, whatever we've executed, we'll end up somewhere around 1100 or 1200 odd crores of net debt. Now, just if we take this number, I wanted to understand, based on the indemnity agreement, what would be the total number that either are third parties who have to pay us, or in case it comes up on the promoters, what would be the total number that we can expect? Obviously, this will happen when the liability materializes. But I just wanted to know that what would be the inflow to the company that will knock off, against this 1,200 odd crores net debt, say probably in the next 12 to 15 months. If you can just give some color on that.
Yeah, I'll try to answer that question. So the total indemnity inflows which would come in either from the promoters or the customers, or the authorities, would be approximately 600 to 650 crores on account of liquidated damages. Perhaps about another 300 to 400 crores on other items, including things like receivables, or if you have any of your inputs stuck with the authorities. So we're talking of a ballpark number of items covered in the indemnity to be between about 1,000 to 1,200 crores.
Okay. And the timeline for this could be in the next 12 to 15 months or much earlier?
No, it can't be, because we have to raise indemnity claims only once in a year.
Okay.
So after considering the 300 crores which had to be borne by the company, the company has already raised an indemnity claim for 30th September 22. The earliest we can raise the next claim, and the number that I'm talking about is not what is included in the present claim. It is only going to be September 23. So it will definitely not be all fructified in 15 months. It can be something fructified in 12 months, 24 months, or if there are legal cases, then it may take longer to fructify as well.
Okay. But maybe the timelines would be different, but on a number-to-number basis, so we have almost 1,000 odd crores that should eventually come into the company. And so whatever debt we are generated now.
1,000 to 1,200 crores.
Yeah,
and,
okay.
A pretty significant portion may come in, not just from the promoters, but even from the customers with whom we will finalize our LD settlement.
Right.
For the next 12 months.
So any realistic number you would want to give us for next September 23, that some or maybe not a realistic but a conservative number that this should definitely come in by September 23.
So if it was already crystallized, I would have already taken it in my September 22 claim. So
Right.
I don't want to put out any kind of number, conservative, realistic, pessimistic. I've given you what is the overall number. We are all striving to see that we recover everything as fast as we can, not necessarily from the promoters, but even from the customers or the authorities wherever it is stuck.
Right. Okay. That's it from my end. Thank you so much.
Thank you.
Thank you. I now hand the conference over to Mr. Amit Jain for closing comments.
Thank you. With the robust backing of Reliance Group and Shapoorji Pallonji Group, we endeavor to accelerate our growth trajectory by aggressively pursuing large markets globally where we foresee a huge potential of growth. India too has reached an inflection point from where we anticipate the growth of solar power industry to garner further pace and momentum. With our deep-rooted client relationships, global presence, ability to provide customized solutions, strong track record of executing complex and large-scale projects, supported by robust balance sheet and the strong parentage of Reliance Group and Shapoorji Pallonji Group, we are confident of regaining our leadership position. I would like to thank everybody for joining the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with Sandeep Thomas Matthew or Strategic Growth Advisors, our investor relationship advisors. Thank you once again and have a great day. Thank you.
Thank you very much.
Thank you.
On behalf of Sterling and Wilson Renewable Energy Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.